Okay class, we are discussing about the converting asset to expense, and we realize that we have different expense, we have different type of expense that is a that need to be paid in advance, but we are not using these services. Okay, we are not consuming, and we will consume and use in any in future time. But in let's suppose in your past period, like if we're talking about the we pay our rent in December. Okay, let's suppose I say I pay my rent 2 month, yeah, 3 month, 3 month rent advance. I pay my 3 month office and home and any place uh, advance rent, advance 3 month rent advance. That is maybe the date of, let's suppose I am talking 1 November. Okay, it is a 1 November in which I am paying 15,000 of each month. Okay, no, simply I say the 20,000 of each month. You know how much I pay that time? 3 months, that's equal to your 60,000 I pay. Okay, it is a 3 month rent. And what type of transaction will be right now you will be performed? That's a simple transaction. I mean, that is a 1st November transaction. You will write simply rent. It is a basically your expense, and I'm saying it is a office rent. Then and I will write the 60,000 as a debit, and then cash will be credit. Okay, because I paid it, and I will pay the 60,000 cash, it will be credit. It is a simple transaction, and it will be going to be happen on a November 1. Fine, I pay a office rent 60,000, it will be debit, and a cash will be credit. Now that's the same logic that we are discussing in this transaction, paid cash in advance of incurring expense. Basically, in accounting terms, you are going to be pay your office rent. Fine, okay, but you are using this rent in next 3 months, next coming 3 months, mean to say November will be completed on a 30 November. Then you will use this rent as a December, and you will use in a January also. Okay, so thing is that now how we can defend if I am talking about that I am going to be close our income statement, and I am going to be report the income statement of November. Then what I will write the office about the rent. I will do a different expense. I will write the different expense. Similarly, I need to be write the office rent. Then am I mention the office rent is a 60,000? Is it a November? No, it is not a November. It is a 3 month. Then I need to be appropriate amount of rent that I use in this November month. Okay, then what I do, I will write there office rent expense. Now right now I can write there office rent expense, because it is not expense. According to your realization and a matching principle, when revenue will be earned and when expense will be consumed, then you need to be write it. Okay, otherwise you cannot be able to write the expense or a revenue. But now at the date of 30 November, if we talk about the 30 November, right now I'm saying the office rent expense. Okay, office rent how much? It is a 20,000, just a 20,000. Okay, and it will be debit, and the which account I will use right now? I will use the second account of am I use the cash account payable? No, because I already pay, so I use the office rent. Okay, we use the office rent account as a 20,000. Fine, as a credit. Okay, it is a basically a transaction that I perform, and it is a adjusting entry. Fine, how I do it? Like now come their transaction. paid cash in advance of incurring expense. It is your expense, but you paid in advance, that it will be considered your asset. Basically your office rent, it is not an expense account, it is your expense asset account. Okay, now I am using our expense on 30 November, 1 month expenses. I use it, I use office. Okay, now I can say office rent is consumed. Now I can write it in my income statement. Fine. So I just, what I do, I recognize the portion of a asset. Portion of a asset is a 60,000, but I just using a 20,000 1 month rent. I recognize the portion of asset, consume as a expense, and reduce the balance of asset account. Okay, by the office rent 20,000, it will be a debit, and there it will be credited. What will the remaining amount? 40,000 automatically. You got my point? Okay, office rent is a reducing. Here I am doing the credit, it is a reducing balance. Fine. So that is the example of converting asset to expense. So we are make a type. What we do, we just simply do as a converting asset to expense. First we make a asset, and then we are going to be convert this asset into our expense account. So the label is the converting asset to expense. Okay, it is the first type that we are going to be discussed, and with the help of this type you are coming and from your prior period to current period. Okay, now we can move on the next slides, and I am going to be remove all these things. Okay class, that is the first transaction that we are discussing about this. And now converting asset to expense, that is some example of insurance, like initially costs that benefit more than one accounting period are recorded as a asset. Yes, we know, we are already familiar about this. Now journal entry about this is that's related to the March 1 unexpired insurance of 18,000. Okay, we are basically using the normal we are purchase insurance policy. Okay, and the March 1 and the 1 year purchase, 1 year, look there, 1 year insurance policy. Fine. Then on a March 1, which type of transaction, what account will be used as a debit and a credit side? Simply we can write the unexpired insurance, because it is the unexpired. No, you will use it on the next year of March next year. Fine. It is just March 1 you are purchase it, and unexpired insurance $18,000, and you paid the cash. Fine. It is your simple transaction. Okay, that you do in a March 1. It is not a adjusting entry. Why? Because that is a simple. Today is the March 1. If today is the March 1, then I make a transaction. I am going to be purchase the insurance policy for the 1 year for my company. Okay, that's I am writing the cash is a credit. That mean I am going to be paid, and it is a expense for me, but it is expense of a 1 year. Fine. And so I make it an unexpired insurance. It is not going to be expired right now. Not expire in this month. Okay, it will be providing the benefit of a whole year, mean to say 12 months. Fine. So I am writing there unexpired insurance or a prepaid insurance. Fine. It is right now my assets, and now I come on a next. Fine. Yes student, we discussing about the journal entry of unexpired insurance, because we are purchasing the 1 year insurance policy, and the entry will be made as a simply we write the cash will be credit, and unexpired insurance will be debit. Okay, we are going to be on next slides how we will use it, the record of adjusting entry. Okay, now the costs are expense as they are used to generate the revenue, like that's a monthly adjustment entry for the insurance of March. We use this in a March, and in a March 31st insurance expense, that is a debit. Now we use in a 1 month. Fine. So we are going to be write as the insurance expense 1500, it will be debit, and unexpired insurance is a 1500. And how we can get the 1500? We simply just 18,000, that is the whole month. Okay, 18,000 you are going to be divide your 80,000 divided on a like just on a 12, okay, whole years on a 12 month, that you can get the 1500 of each month. Fine. It is a one way to using I mean you have to perform the adjusting entry. That's we are discussing again the converting asset to expense. Okay class, now we can move on a next transaction. Now that's reporting the converting asset effect of the income statement and the balance sheet. Fine, look there. And a cost of asset, that is a benefit in future period. It is a unexpired insurance on a 3 March, first March 18,000 you purchase it, okay, and on a 330 first it will be credit on a March, okay, and balance is a 16,500. Yes, student. Now that is the point in a balance sheet. I mean to say unexpired insurance, and first you purchase 18,000 and you make a transaction of 1500. It will be credit unexpired insurance, and you have remaining balance of 16,500. And you will report income statement cost of asset. Use this period to generate a revenue that is just on a 1 month expense that we will be mentioned in our income statement. So the insurance expense is 1500, and it is going to be mentioned there. Okay, that is a particular ledger. With the help of the ledger you can understand about the balance sheet and income statement, how the transaction of assets, cost of asset that benefit more than one accounting period will be going to be convert in a in income statement account, that is insurance expense, and the label we are going to give the converting asset to expense. Fine. Now similarly another case that I am going to be discussed with you people, it is a type of a converting liability to revenue. Okay, it is a type of a converting liability to revenue. Look there, it is a type of converting liability to revenue. So the converting liability to revenue, again that's also a case of advances, but it is not our expense right now, but it is a when a company is receiving a cash advance, okay, that is a collected cash in advance earning revenue create a liability. Okay, in prior period in any like if we keep in a example, your previous example, I mean your assets expense, rent expense as a landlord will be received as a cash will be debit. Okay, it will be a cash. Okay, I'm using a board and give you a same repeat this example again. Like if we discussing about the uh, on 1 November, on a 1 November your landlord will receive a cash, and in his book keeping what he will be write the he will write as a cash will be 66. I guess that is a I guess we give 20,000 of each month. I know. Okay, six cash is a 60,000 he will receive, and it is a basically a revenue of a landlord. Okay, but it is a if we say that is a revenue, simple. Okay, revenue and 60,000, but in accounting it is a just 1 month, it is a advance cash. Okay, so in accounting it will tell that you need to be write unearned revenue. It is a not a earned revenue, you are using the account unearned revenue. Okay, unearned revenue is the 60,000 because our flat, our house, office is not used still, but in a we cash receive a cash advance. Okay, it is a 1st November transaction. Similarly, if a 30 November transaction will be adjusting entry, and what will be happen there, then we will do unearned revenue, unearned revenue 20,000. Okay, and same is like your earned revenue. and revenue is a 20,000. Your transaction should be look like this. It is your adjusting entry, and how you do it, it is a basically first we make a liability, that's is your liability. Unearned revenue 60,000, it represents the liability account, not as a revenue account, okay, because we are mentioning there unearned, as you will receive the cash, okay, in advance. It is not a time of your earning, because you not give the services, you not give a product are not delivered that time, okay. So it will be a just a revenue, unearned revenue, it will creating a liability, okay. Then in a 30 November, okay, as the 30 November you come on a current period, and you know one a month is going to be complete, then we can say it is our earn revenue, fine. 20,000 is your earn revenue, so we can say reducing portion of earn as a revenue and reducing balance of a liability account, okay class. It is a basically a thing that I'm going to be discussed with you people, that's converting liability to revenue. One another thing that we are going to be discussed, it is the first two type, that converting liability to revenue, converting asset to expense. And now we are go in the next slides. It is a basically related to a accruing unpaid expense, accruing unpaid expense, okay ji. Accruing unpaid is a relate to the current to future, very easy concept, current to future. In a adjusting entry you are recognizing the expense, like expense are occur and it will be incurred in a current period, but we will not pay at the time, and we are going to be paying in a future time, like your salary. If you have a salary of an employee, salary expense will be occur at the month of November, but you are going to be paying a 5 December, that is creating a account payable. That is a very simple concept, that's the accruing unpaid expense, mean to say your expense will be occur but you are going to be unpaid. Realizes the expense incurred and record the liability for the future payment, okay. And the transaction pay cash in a settlement of a liability in any future time, okay. It is a basically we are going to current to future time, okay. It is a one another concept that is related to not advances case, we are focusing there current to future time. In a current we do a adjusting entry, here we do a adjustment, okay. And in our this adjustment we are make a plan to pay our money in future time, that's in a future time you just make a simple settlement of the liability, fine. It is another example. Right now I am going to last one is related to a collection, I mean to say you are accruing uncollected revenue, okay. When you providing the services to your client but your client is not pay you, okay. It's record the receivable, account receivable, it is called the uncollected revenue. What is this? Accruing uncollected revenue, mean to say services are rendered, product are delivered, and right now we need to we are receiving cash, your services will be earned, okay. You can write there like it is the recognize the revenue earned but not yet recorded, and the record receivable, and in a future time when you will write it, it will be collect the cash in settlement of a receivable. Simple, you are going again current to future time. That is the four transaction that I am going to be briefly discuss, and in further we will do a more example, and will be learn about its detail, okay. Allah Hafiz for this session.